first two decisions here, whether or not to accept special orders and whether or not to make your pricing decisions at this particular price or a higher level or a lower level, depends upon some of the information, and you need to consider some of the factors here. So first decision here, whether to accept a special order or not. What are some of the things that you may be able to guess that you will need to consider if you're a manager? You produce regular products and now you have a customer that requests a large quantities of these products at once. Perhaps it beats all the 100 customers' orders quantities in quantities. So basically, if 100 customers perhaps will be able to purchase 1,000 products from you, this particular customer is already requesting 1,000 products in one order. Whether or not you're able to accept this order, what do you think it's based upon? I mean, how would you make your decision? How much material you have on hand, do you actually have enough to produce the products? How much time you have? So all of these factors in capacity, right? Could be the capacity of the machines, capacity of their labor, capacity of basically the total facilities that you have, machines, the tools. Are you actually able to make all these products? Are you able to actually make them on time as requested from customers? So this is the initial consideration here. Do you have excessive capacity? This is the first and the most important one. This is the assumption of whether to accept it later on. You have to fulfill this requirement before doing any further analysis. So for example, if you own, let's say, a small copier printer company. You have 3 machines in your business, and if these machines work 12 hours, since assuming that your operation hours is 12 hours every single day, and they continue to copy nonstop, let's say every hour they're able to do 1,000 pages of copy jobs. So 12 hours, you're able to do 12,000 for this machine, 12,000 for the other, and another 12,000 pages for the third machine. Altogether, every single day, your maximum capacity is 36,000 pages, right? So this is the physical capacity of this business. For every single day, they may be just able to copy nonstop 36,000 pages. So if a customer comes in to request a printing job, let's say right now you already have customers requesting 20,000, and another customer comes in to request another 20,000 pages in a day. Let's say they want to copy all of the materials they need for the entire semester. The physical capacity tells you that the company is actually not able to accept this order, right? They currently already have these much orders. They now want to add in one more, but altogether you need to produce 40,000 copy pages for the customers. The physical capacity here already is lower than the request from customers who may not be able to accept this order unless you are willing to purchase another machine to do this job. But if this is not a regular order that comes in every single season or on a regular basis, this is not worth it, right? So the first consideration here is whether you have enough machine, enough material, enough people to actually fulfill the requirements that the customer is asking. Now let's say you do have enough capacity. You have actually 4 machines. So what will be the next question? You do have idle machines there. You can fulfill the request. Now what if the customer now demands a lower price than other customers? Since right now they're giving you a large quantity of job here, and if before each page you cost, let's say 50 cents, now they're demanding each page with just 10 cents. So what would be the second question? If there's even a profit there, exactly. The second question, if you do have capacity, the second question would be, is the incremental sales, even though you're providing them at a discounted price, is the incremental sales actually more than the incremental cost? So meaning that if the variable cost for generating one page plus the fixed cost, let's say, is already 10 cents, and they're demanding a revenue at 10 cents, meaning they're only asking you to charge them at 10 cents. This just actually covers the cost, but you're not generating any profit here. Okay? So this discount amount, of course, you may be able to provide them a discount perhaps at anywhere between 0.4 and 0.2, or somewhere more than perhaps 15 cents a page. Any number above this variable cost plus fixed cost will be able to give you a profit. So you have to set the price or negotiate a price with them at a discounted point, but you're still getting profit. Okay? So to sum up, this decision making, if you draw a decision tree here, first question you're asking is whether you have enough capacity. So you need to evaluate the tools, the machines, equipment you have in the business. If you do fulfill this question, you do have enough capacity. Second question is, are they demanding a discount price? And is that price enabling your company to actually cover fixed cost and also cover variable costs? If this also gives you a profit, then you can accept the order. Otherwise, you will need to decline it because you definitely don't want to accept a job using up all the facilities, the time, but then not generating enough profit. Perhaps if you don't accept that order, you just accept regular customer's order, you may be able to get more profit from that. Okay? So again, the first question here, is there enough capacity, idle facilities to help you fulfill this requirement? Even though it's a large quantities job, it's very appealing, but if there's no profit, then you still need to reject the special order. Okay, so if your company already reaches the break-even point, then to accept a special order, the decision is actually even easier because you just need to cover the variable costs that the special order requests. Remember, if the company breaks even, that means they readily cover the fixed cost. So as long as your fixed cost is within the specific relevant range, you're not bumping into a second range or a third range. As long as you're within the fixed cost relevant range, it doesn't change, and you may be able to accept this customer order as long as you cover the variable cost. Okay, so this is also using the concept we learned in last chapter. Remember, variable cost, fixed cost, this portion happens no matter what. So if you already have a break-even sales that covers fixed costs, covers variable costs at that point, any orders above that, you just need to cover the variable cost part because this is already covered from all the break-even sales that you made.
So the deciding factor would be if the order goes beyond the cost of the first
The relevant range?
variable cost.
Well, okay, say that again?
So I'm saying the deciding factor would be if the order covers the incremental cost of each.
Well, if your company already broke even, then the fixed cost is already covered. And if the new order that comes in does not bump your fixed costs into a higher range, then you just need to cover the variable costs and case closed. You can accept the order. Okay? But if your company hasn't break even yet, you also need to consider fixed costs because you need to make sure that this order also covers fixed costs, not at a sales price too low that doesn't cover either one of them. Okay? So the general idea here is these two questions. Other side considerations would be if you have idle capacity, but the order is large to a quantity that actually bumps your fixed costs into a second range, then you need to reconsider this as well. Okay, but most of the problems you see in the chapter, unless it specifically tells you the fixed cost has a different rate after accepting the special order, you can assume that fixed cost is the same. So basically, variable cost is the one that plays the most important role. You need to obviously cover that, get contribution margin for each unit you're producing before discussing anything else. Okay, so these two questions. Other considerations, perhaps you may want to consider also would other customers know about this, right? So this depends on customers' relations, how well you're able to negotiate with these customers to ask them to either keep it to themselves, or you can set specific strategies that this discount is only for certain quantities and up, or for certain seasons, right? So to avoid some of these problems, you may also set some strategies, or some of the companies may decide just to not risk this and just set the price as the 50 cents and above. They don't want to provide discounted price. Of course, the risk is you may not be able to get this order from customer anymore. Perhaps you can reduce these risks. Okay, so these are just some of the considerations that management level will need to keep in mind before they make these decisions. Okay, this is the first one, special order. Related to numbers, the ones are definitely, you need to compare incremental cost against incremental sales. If sales exceeded, covers variable costs, covers fixed costs, that's the most important thing, you're getting profit, then this will lead you to actually accept the special order.